All right, welcome to your deep dive. We're going to be looking at something a little bit different today, something that you wouldn't normally find in your portfolio.
Oh, intriguing. What's on the docket today?
Well, we're going to be looking at quantum field theory in economics and finance.
Oh, wow. That's quite a combination.
Yeah, you sent over some fascinating papers and some excerpts, so I reached out to our expert here to help us unpack all of it.
Well, it's not every day that somebody wants to talk about, Feynman diagrams and forward interest rates in the same breath. So I'm definitely intrigued. Where should we start? What really caught your eye in all of this?
I think initially it was the sheer novelty of it.
Right.
I mean, quantum mechanics and Wall Street, that's a headline I wouldn't expect to see.
Definitely an attention grabber.
But, the more I dig into it, the more it seems like there's some real substance here. It's not just, physicists trying to flex in a different field.
I think you're picking up on something really important there. And that is that the application of quantum field theory, or QFT, to finance isn't about literally finding quantum effects in the markets.
Right.
It's more about the mathematical toolbox that QFT provides.
Okay, so let's break that down a little bit. I mean, I get the basics of QFT, right? You describe fields. Particles are excitations of those fields, sort of like waves in an ocean.
Yeah.
But how does that translate to, predicting whether a stock is going to go up or down?
So think about it this way. Traditional financial models, even the very sophisticated ones, often rely on simplifications, right? They might assume that asset prices move in this predictable way, sort of like a gentle stroll.
Okay.
But real markets are a lot more like a mosh pit.
That's one way to put it. So you're saying that quantum field theory is better at, capturing that chaotic dance of the markets?
Exactly. QFT is really built for systems with a huge number of interacting components, where things are constantly fluctuating. Does that sound familiar?
Yeah.
That's what markets are all about. So it gives us this really powerful way to model that mosh pit more accurately.
But, how does it actually do that? I keep seeing all these terms like Lagrangian and Hamiltonian.
Yeah.
It all feels very physics classroom, not very trading floor.
All right, let's make it a little more practical.
Yeah.
You mentioned one of your sources focusing on QFT-based option pricing models. And I think you're familiar with the classic Black-Scholes formula, right? It revolutionized options trading, but it does have its limitations.
Right, because Black-Scholes assumes things like constant volatility, which we know is not true in the real world.
Exactly. And that's where QFT can really shine, because instead of just looking at an asset's price, QFT models can incorporate what's called its velocity. It's like how quickly the price is changing. So it's like having a speedometer on top of your price chart.
Okay, so I'm starting to see how this goes beyond just theoretical physics. So the QFT model would see a stock suddenly speeding up, and it would factor that into the option price.
Precisely. And what's really interesting is that when you actually compare QFT-based models to Black-Scholes using real market data, the QFT ones often outperform, especially when things get volatile.
Okay, that's pretty impressive. Let's talk about something specific. You mentioned forward interest rates before, something I'm always trying to wrap my head around. How does QFT help in that area?
So one of the things that you highlighted in your sources was that QFT models for forward interest rates directly incorporate empirical volatility. They don't need, an extra parameter, a fudge factor,
right,
to account for how wild the market is being.
So it's a more grounded model, less reliant on guesswork. But how does QFT capture that volatility without needing that extra parameter?
Well, it's all about how the models are actually built. You see, the QFT framework allows us to mathematically connect the observed market volatility to the fluctuations in those forward rates. It's kind of baked into the equation, so to speak.
Okay, well, that's pretty elegant. So we've gone from option pricing to interest rates, all with this, seemingly abstract physics theory. What other, financial beasts does QFT try to tame?
Well, one area that I think is particularly intriguing and computationally challenging is the quantum LIBOR market model, or QLMM.
Oh.
And this dives into the world of LIBOR rates, the interest rates that banks charge each other.
Oh, LIBOR. Now that's a whole other can of worms, right? Especially after those manipulation scandals a while back. Didn't traditional models really struggle to capture that kind of behavior?
You're exactly right. And that's what's so fascinating about QLMM is that it's not just about replicating what we've seen. It's about trying to build a model that's fundamentally robust enough to handle those kinds of unexpected events.
Well, so it's not just about a better fitting curve to the past. It's about a model that might be more resistant to those black swan moments.
That's the goal. Of course, simulating something like QLMM is computationally intense. We're talking about recreating like a virtual universe of interconnected interest rates.
Okay, now I'm really intrigued. How do they even begin to tackle that?
Well, this is where things get even more interdisciplinary. They're actually borrowing techniques from what's called lattice quantum field theory.
Okay.
Imagine taking that smooth, continuous flow of the financial markets and breaking it down into a grid, like pixels on a screen.
So we're like pixelizing the market. That's a wild image.
It is a way to make the problem manageable. So instead of trying to solve for everything all at once, they break it down into these little chunks, calculate on those, and then stitch it all back together.
So they're using the power of computers to like brute force a solution to this quantum model of LIBOR. That's some serious computational firepower. But does it actually work?
Well, the early results are actually quite promising. They've been able to replicate many of the real-world features of LIBOR, including those sudden jumps in correlations that traditional models miss.
Wow, so we're not just talking about theory here. It sounds like QFT is making a tangible impact on like how we understand finance.
It's still early days, but I think the potential is huge. What's really exciting is that this isn't just about specific models like option pricing or LIBOR. QFT kind of offers this new perspective on the fundamental nature of financial markets.
Okay, now we're getting into the deep philosophical stuff. I'm ready. Lay it on me.
Well, one of the things that you marked in The Evolution of Money was the idea that money itself might be kind of an illusion, this shared belief that gives these otherwise meaningless tokens their power.
Right, like a dollar bill is just a piece of paper, but we've all agreed it has value, so it does.
Exactly. And this ties into how QFT models are structured. You see, they don't rely on some inherent true value of an asset. They're built on the interactions, the fluctuations, the collective behavior of everyone in the market.
So it's not about finding like some fundamental law of finance, like Newton's laws for gravity. It's about capturing like the emergent complexity of the system itself.
Precisely. And this becomes even more intriguing as we move towards increasingly virtual forms of money, like cryptocurrencies. Where's the ground truth of value when everything is just bits and bytes?
Okay, now my brain is officially doing backflips. This is exactly the kind of deep dive I was hoping for.
But we're just getting started. There are even more fascinating applications of QFT in finance, from modeling complex bonds to potentially even understanding macroeconomics on a new level.
I am ready. Bring on the next layer of the quantum onion. Okay, I'm trying to picture this, like quantum onion of finance. You mentioned macroeconomics before. Does QFT really have anything to say about, how entire economies work?
Well, it's definitely a newer area of research, more speculative.
Right.
But remember how we were talking about QFT being really good at handling systems with tons of interacting parts?
Yeah.
Economies definitely fit that bill, maybe even more so than financial markets.
Right. You've got consumers and businesses, governments, all these different sectors, kind of pushing and pulling on each other. It's just this giant, messy system.
It is a giant, messy system.
Mm-hmm.
Exactly. And traditional macroeconomic models often have to make, simplifying assumptions to make the math work.
Mm-hmm.
They might treat, all consumers as if they're identical, or ignore certain feedbacks between sectors.
Which we know isn't really true in the real world, right? I mean, everyone's got their own quirks, and one person's spending is another person's income.
Exactly, and that's where I think the QFT approach could offer a really fresh perspective. One of the ideas that's being explored is this concept of a microeconomic potential.
Okay.
It's kind of analogous to potential energy in physics, but instead of gravity, it's this underlying force that's driving the evolution of market prices across the entire economy.
So like some hidden economic force field that's pulling all the strings.
It's an intriguing way to think about it, and QFT gives us those mathematical tools to model how this potential would interact with the different, quote-unquote, particles in the economy.
Yeah.
Goods, services, labor, capital, that sort of thing.
Okay, so I'm starting to see the potential here. No pun intended, but it still feels pretty abstract. Like, are there any concrete examples of how QFT is being applied to macroeconomic problems right now?
Well, one area that's getting a lot of attention is commodity price modeling.
Okay.
So think about the price of oil, for example. It's influenced by a whole web of factors, right?
Yeah.
Supply and demand, geopolitical events, technological advancements, you name it.
Right.
Traditional models often struggle to capture all those nuances.
Yeah, because they tend to focus on just a few key variables and kind of treat everything else as static or predictable.
Exactly. But QFT allows us to build models that can incorporate a much wider range of factors and their interactions, including those feedback loops that we were talking about before. So instead of just looking at, simple supply and demand curves, a QFT model could incorporate things like the impact of climate change on oil production or the development of new renewable energy sources.
Okay, so it's like we're taking those like static economic models and giving them a jolt of like dynamic energy. But I have to admit, I'm still a little fuzzy on the specific mathematical tools that QFT brings to the table. I mean, we keep dancing around terms like Lagrangians and Hamiltonians, but I'm not sure I really grasp what they actually do in a financial context.
Yeah, you're right. It's time to give those concepts some real world meaning. So let's go back to that roller coaster analogy for the Lagrangian for a second. Remember, it describes the energy of the system as it moves along its track.
Right. It's like the blueprint for, how much energy the roller coaster needs to make it through those loops and twists.
Exactly. Now, imagine you're building a portfolio instead of a roller coaster.
Okay.
Right? Your track is your investment strategy, and the energy is the performance of your portfolio over time.
Mm-hmm.
So the Lagrangian, in this context, would capture all those different factors that contribute to your portfolio's performance, asset prices, interest rates, maybe even things like market sentiment or economic indicators.
So it's like a mathematical formula that describes the energy landscape of my portfolio.
Precisely. And by analyzing this Lagrangian, we can identify potential risk and opportunities, optimize our investment strategy, and even, predict how our portfolio might perform under different market conditions.
Okay, now that's starting to click for me. We're taking this abstract physics concept and like grounding it in this very real world of investing.
Mm-hmm.
What about the Hamiltonian? Where does that fit into the picture?
Well, remember the conductor of an orchestra.
Yes.
Okay, the Hamiltonian is like the maestro of your portfolio.
Okay.
It takes all those different factors captured by the Lagrangian, the asset prices, the interest rates, and it dictates how they, interact and evolve over time.
So it's like the rules of the game, the underlying mechanics that govern how my portfolio's symphony unfolds.
Exactly. The Hamiltonian tells us how those different instruments in our portfolio, the stocks, the bonds, the commodities, how they harmonize or clash, how their movements, influence each other, and how the overall composition of the orchestra changes as the market shifts.
Okay, so I'm starting to appreciate how these concepts, which, seemed so distant and abstract, can actually be applied to something as tangible and as important as managing my money. But what about the more technical stuff, like Feynman diagrams? I remember seeing those in physics textbooks, but how on earth do they apply to finance?
Well, you'd be surprised. Feynman diagrams, while initially developed to, visualize particle interactions in quantum physics, they're surprisingly useful for organizing, complex calculations in QFT.
Okay.
Even when it's applied to finance.
So they're like visual shorthand for all those complicated equations.
Exactly. So instead of getting lost in, the sea of symbols, Feynman diagrams allow us to break down those calculations into smaller, more manageable chunks. Each line and squiggle in the diagram represents a specific, interaction or process. And by connecting those pieces together, we can build up this visual representation of the entire model.
So it's like having a blueprint for the model itself, making it easier to understand and analyze. But I'm still a bit skeptical. How do we know that these models, even with all their fancy math and diagrams, actually reflect what's happening in the real world? I mean, markets are notoriously unpredictable.
You're right to be skeptical. The real test of any model is its ability to make accurate predictions. And that's where the emphasis on empirical testing comes in. Every QFT model, whether it's for option pricing, interest rates, or even macroeconomics, it needs to be rigorously tested against real-world data.
So it's not just about theoretical elegance. It's about proving that these models actually work in practice.
Exactly. And one of the exciting things about this field is that researchers are constantly, comparing their models to real market data, refining them, developing new ones. It's a very dynamic and evolving field, driven by both theoretical insights and empirical validation.
Okay, I'm starting to see the value here. It's not just about finding some magic formula that predicts the future with 100% accuracy. It's about building models that are more sophisticated, more robust, and ultimately more useful for understanding and navigating the complexities of the financial world.
Precisely. And it's this pursuit of Better models, better tools, better insights that really drives this field forward. It's about pushing the boundaries of what we know and how we think about finance.
It's like we're upgrading our like mental operating system for understanding the market. But speaking of upgrading, I remember how we were talking about those index-linked coupon bonds before.
Yeah.
Those always seemed particularly tricky to model with traditional methods. Does QFT offer any advantages there?
It definitely does. Remember, these bonds have interest payments that are linked to a publicly traded index, like a stock market index.
Right.
So their value is kind of tied to two sources of randomness: the index and the prevailing interest rates.
It's like trying to predict the movement of a dancer who's like constantly changing partners and steps.
Perfect analogy. Traditional models often struggle with this kind of, double uncertainty. But QFT is kind of built for it because by incorporating both the index and the interest rate dynamics into a single coherent framework, QFT can provide a much more accurate and nuanced picture of how these bonds behave.
So instead of having like two separate clunky models, we get one elegant integrated model that captures the whole dance.
Exactly. And this unified approach has a lot of, practical implications. It can lead to, more accurate pricing of these bonds, better risk management strategies, and even new investment opportunities.
Okay, I'm convinced QFT isn't just like a theoretical curiosity. It's a powerful tool that's changing how we think about and interact with the financial world. But I'm curious, are there any areas where even QFT struggles to provide answers? Like where are the current frontiers of this research?
That's a great question. And it gets to the heart of what makes this field so exciting. While QFT has shown tremendous promise, there are still, many challenges and open questions. One of the biggest is dealing with the sheer complexity of the systems that we're trying to model.
Right.
Even with the powerful mathematical tools of QFT, capturing all the nuances and the interconnectedness of a global financial market or a planetary climate system, it's a daunting task.
It's like trying to map the entire universe down to the last atom. Like there's always going to be something that we miss.
Exactly. We have to make simplifications and assumptions, and those simplifications and assumptions can sometimes lead to inaccuracies or blind spots in our models.
So it's like this constant like balancing act between making the model complex enough to capture the essential features of the system, but not so complex that it becomes like unwieldy or computationally intractable.
Precisely, and that's where a lot of the current research is focused on developing new techniques and approaches for handling this complexity.
Right.
For finding that sweet spot between accuracy and practicality. Another big challenge is the availability of data.
Right.
QFT models, especially those used in finance, they rely on vast amounts of data to make accurate predictions. But sometimes the data that we need might be incomplete, unreliable, or simply not available.
It's like trying to like bake a cake without all the ingredients. Like you might be able to improvise, but the final product won't be quite the same.
Exactly, and that's why data science plays such a crucial role in this field. Researchers are constantly developing new methods for collecting, cleaning, and analyzing data, for extracting meaningful signals from the noise.
It's like we're building bigger and better telescopes to observe the financial universe in more detail. But even with the best data and the most sophisticated models, there's still one crucial ingredient that's incredibly difficult to capture, and that's the human element.
You've hit upon one of the biggest challenges and the most exciting frontiers of this field.
Mm-hmm.
As you said earlier, people don't always behave rationally, and their actions can have a huge impact on financial markets, on economies, and even the climate.
It's like trying to predict the weather, but the wind keeps changing direction because people are like flapping their arms.
It's a chaotic system for sure, and that's why integrating a more robust understanding of human psychology and behavior into these QFT models is so crucial.
So we need to find ways to bridge the gap between the elegance of mathematics and the messiness of human nature.
Exactly, and that's where collaborations between physicists, economists, psychologists, and even computer scientists are becoming so important. So bringing together different perspectives and tools to tackle this truly interdisciplinary challenge.
This is also fascinating. We've covered a lot of ground today, from the basic principles of QFT to its applications in option pricing, interest rate modeling, macroeconomics, and even the philosophical implications of money itself. It's clear that this is a field that's still in its early stages, but it's already having a profound impact on how we think about and interact with the world of finance.
And for you as someone who's, clearly deeply engaged with these ideas, it's an invitation to keep exploring, to keep questioning, and to keep pushing the boundaries of what's possible. The future of finance is being shaped right now.
Right.
And who knows what incredible discoveries await us at the intersection of physics, economics, and the human mind.
I'm definitely feeling inspired. But before we get too carried away with future possibilities, I want to make sure that we've tied everything we've discussed back to the specific sources that you sent over. We've talked about a lot of concepts, but I want to make sure that we've extracted the key insights and applied them to your particular areas of interest.
That's a great point. Let's revisit those sources and see how all these pieces fit together.
Yeah.
One of the things that you highlighted was that graph comparing a QFT-based option pricing model to the classic Black-Scholes formula.
Right. It showed that the QFT model actually outperformed Black-Scholes, especially during periods of high market volatility.
Right.
And that really caught my attention.
Right. And it gets to the heart of why QFT is so promising for finance. Black-Scholes, while groundbreaking in its time, it relies on certain assumptions that don't always hold true in the real world. For example, it assumes that asset prices follow this specific type of random walk called geometric Brownian motion.
Right. It's like assuming that the market always strolls along at a steady pace, never breaking into a sprint or a stumble.
Exactly. But in reality, asset prices can exhibit much more, complex and erratic behavior, especially during times of crisis or uncertainty. QFT models, with their ability to incorporate nonlinear dynamics and capture those sudden jumps and fluctuations, they provide a much more realistic and robust framework for understanding those market movements.
So it's like upgrading from a horse-drawn carriage to a high-speed train.
Exactly. And that graph that you mentioned is a testament to the power of this approach. It shows that when we compare these models head to head, using real world data, the QFT model, it comes out on top.
It's impressive. But does that mean that Black-Scholes is obsolete? Should we throw out all our old textbooks and start from scratch?
Not necessarily. I mean, Black-Scholes is still a valuable tool, and it has its place in certain contexts. But I think it's important to recognize its limitations and to be open to new approaches that can offer a more nuanced and accurate picture of the market.
So it's about expanding our toolkit, not discarding the old tools entirely.
Exactly. And QFT provides a whole new set of tools, a new way of thinking about and modeling financial phenomena.
Okay, I'm seeing the value here, but I'm also curious about the practical implications of this. Like how accessible are these QFT models to people who don't have a PhD in physics? I mean, this is all pretty advanced stuff.
That's a valid concern. QFT is a mathematically demanding field, and it takes time and effort to master its intricacies. But the good news is that you don't need to be a quantum physicist to benefit from these insights.
So you're saying I don't need to go back to school for another decade just to understand how QFT can help me manage my portfolio.
Exactly. Just like you don't need to understand how a computer works at the the deepest level to use it effectively. You don't need to become a QFT expert to leverage its power in finance.
Okay, that's a relief. But how do I bridge that gap? Like, where do I even begin to access these tools and insights?
Well, that's where the field of financial technology or fintech comes in. Researchers and developers are working to translate these complex QFT models into user-friendly software and platforms that can be can be accessed by a wider audience.
So it's like the evolution of the internet, right? What started as a specialized tool for academics and researchers is now accessible to anyone with a smartphone.
Precisely. And that's what's happening with QFT in finance. It's moving from the realm of theoretical physics to the world of practical applications. And as that happens, it's becoming more accessible to investors, to traders, and anyone who's interested in understanding the market from this new perspective.
That's incredibly exciting. It's like we're on the cusp of a revolution in how we think about and interact with the financial world.
It's a revolution that's being driven by the convergence of multiple fields, physics, mathematics, computer science, economics, and even psychology. And as these fields continue to intersect and collaborate, who knows what amazing discoveries await us.
I can't wait to see what the future holds. But for now, I think we've reached the end of our deep dive into the world of QFT in finance. We've explored a lot of complex and fascinating ideas, and I'm sure our listener is feeling both intellectually stimulated and perhaps a bit overwhelmed.
It's been quite a journey, hasn't it? But hopefully it's also been an enlightening one. The goal of a deep dive isn't to overwhelm, but to inspire, to open up new ways of thinking and to show that even the most seemingly abstract ideas can have real world implications.
I couldn't agree more. And for our listener, who's clearly someone who's eager to learn and explore new ideas, this is just the beginning. The world of finance is constantly evolving, and those who are willing to embrace new perspectives and challenge conventional wisdom will be the ones who thrive in this dynamic and ever-changing landscape. But before we sign off, I want to leave our listener with a final thought-provoking question. We've seen how QFT, a theory developed to describe the universe at its smallest scales, can be applied to understand the complex world of finance.
So as we wrap up this deep dive, let's ponder the broader implications of this approach.
Exactly. If we can use the tools of quantum physics to model financial markets, what other complex systems might be amenable to this kind of analysis? Could we use QFT to understand climate change, social networks, or even the human brain?
It's a question that pushes us to think beyond the traditional boundaries of disciplines, to see the connections between seemingly disparate fields, and to recognize that the pursuit of knowledge is an interconnected and ever-evolving journey.
And that's the beauty of the deep dive, isn't it? It's about taking a deep breath, diving into the unknown, and emerging with a new perspective, a new set of tools, and a renewed sense of wonder about the world around us. So to our listener, thank you for joining us on this intellectual adventure. Keep exploring, keep questioning, and keep pushing the boundaries of your own understandings. We started this deep dive talking about quantum mechanics, which most people associate with the tiniest particles imaginable. And here we are talking about the global economy and, even the human brain. That's quite a leap.
It is, and it really speaks to the power of this mathematical framework. QFT isn't just about, describing quarks or electrons. It's really about understanding how complex systems behave, regardless of the scale.
Yeah, one of the things that keeps coming up in these sources is this idea that traditional models, even the really sophisticated ones, they often miss the mark because they're too focused on equilibrium.
Yes, the everything nicely settles down assumption. It definitely makes the math a lot easier, but the real world rarely seems to cooperate.
Exactly. Markets crash, pandemics happen, oil prices spike. It seems like QFT is just better equipped to handle those kinds of shocks, those moments where the system is thrown completely out of whack.
That's a key insight. You're picking up on how QFT treats fluctuations as fundamental.
Yeah.
It doesn't see them as, noise to be smoothed over, but as really the very essence of how the system evolves.
So instead of trying to predict exactly where things will land, it's more about understanding the range of possible paths, the probabilities of different outcomes.
Precisely. It's like the difference between, forecasting a single temperature for tomorrow versus, modeling the entire probability distribution, the chances of it being, cold, mild, or scorching hot.
That makes a lot of sense, especially in finance, where, certainty is an illusion. But how do these QFT models actually account for those big, unexpected events, those black swan moments, as they're called?
Well, one approach is to introduce what are called nonlinear terms into the models.
Okay.
These represent the kinds of feedback loops and cascading effects that can amplify small shocks into, major disruptions.
So it's like adding a layer of complexity that captures those spiral out of control scenarios.
Exactly. It's
Yeah.
about acknowledging that sometimes the system's response to a shock isn't, proportional to the shock itself. Small causes can have big consequences, and QFT gives us that mathematical language to describe that.
But doesn't that make the models even more computationally challenging? I mean, we've already talked about how simulating something like QLMM is a massive undertaking.
It does, and it's a trade-off, right? The more accurately we want to capture those complex interactions, the more computational horsepower we need.
Right.
But that's where advancements in computing power and algorithms come into play.
So it's like we're in an arms race between the complexity of the financial world and our ability to model it.
In a way, yes.
Yeah.
And it's a race that's pushing the boundaries of both physics and computer science.
Okay, before we get too lost in the computational weeds, I want to loop back to something you said earlier that really struck me. This idea that money itself might be an illusion. It's pretty mind-bending concept, especially for someone who spends a lot of time thinking about finance.
It's a challenging idea for sure. But it highlights something really fundamental about how we've structured our economic system. Money, whether it's, gold coins, paper bills, or digital bits, it has no inherent value in and of itself.
Right. It's just a representation of value, a way for us to, keep track of exchanges and store purchasing power.
Exactly. And its value is ultimately derived from our collective belief in it. From the trust we place in this system of symbols and promises.
Or it's like a giant ongoing social experiment, a shared hallucination that we've all agreed to participate in.
It's a provocative way to put it, but there's truth to it. And this becomes even more apparent as we move towards, increasingly abstract forms of money like cryptocurrencies.
Right.
They're not tied to any physical commodity or government backing. Their value is purely a product of the network, of the shared belief of those who use them.
That's both fascinating and a bit unsettling. It makes you wonder about the long-term stability of a system that's ultimately built on such a fragile foundation.
It's a valid concern. As we become more reliant on these virtual forms of value, understanding the dynamics of trust and belief becomes crucial. It's no longer just about the numbers. It's about the psychology of the market, the collective narratives that drive our behavior.
Okay, now my head is really spinning. We've gone from quantum fields to the psychology of money. It's clear that this is a topic with endless layers, endless connections to explore.
And that's the beauty of a deep dive like this. It's not about finding all the answers. It's about opening up new questions, new perspectives, new ways of seeing the world.
I couldn't agree more. So to our listener, thank you for joining us on this incredible journey. We've covered a lot of ground, from the intricate mathematics of QFT to the philosophical implications of money itself. But more importantly, we hope we've sparked your curiosity, inspired you to think differently, and encouraged you to keep exploring this fascinating intersection of science, finance, and the human mind. Until next time.